So temporary buy down versus a long-term buy down. Different situation, different scenarios. Talk to your local trusted lender. If you need a great lender in the Denver metro area, reach out to me. I have amazing lenders. They can actually lend in a bunch of different states, but I have great lenders that can advise you on what makes sense for your situation, because it all depends on your situation. So, but what a lot of people are talking about right now is a temporary buy down versus the long term. So the long term is a little bit more traditional and essentially says, okay, let's say the market rates are 7%. That's what the lender quotes you. But you can do a permanent buy down or a long-term buy down to 6.5%. And maybe that costs you $10K. Okay. Because the lender says, well, I'm not going to be able to make the money in the life of the loan because now your interest rate's lower. So I need to make the money for the difference up front. And I'm going to charge you that up front in closing costs. So you could use a seller credit to do a long-term buy down on your loan. But let's say you're like, nah, I'm going to refi this in a couple of years because I think the rates are come down, or I'm going to move, or I'm going to do something. I only need a better interest rate for a short period of time, usually because you're going to refi or you're going to move. So you can consider using those seller credits to do what's called a temporary buy down. Now your lender can structure different ways, a 3-2-1, a 2-1, and a 1-0. There's options there. Usually those are three most common options. But I'm going to talk about a 2-1 because it's kind of in the middle and it's enough to explain the scenario without getting too confusing. So I'm going to link to up above and down below a detailed explanation of this, but essentially it's saying, okay, if that quoted rate at no cost is 7% from the lender, and I am not a licensed lender, I am not quoting any particular rates. This is just numbers for example, because this is what my clients are seeing in the market right now. But let's say the lender quotes you a 7% rate at no cost, no additional cost. Then a 2-1 buy down would say, okay, we're going to take that money from the seller. We're going to put it in this little account and we're going to lower your interest rate for the first year of your loan to 5%. So now the difference in your payment might be $200 a month, probably more, to be honest, like $250 a month. Saves you a lot of money. So that extra $250 a month, where does that come from? Like, how do they magically lower your payment? They're going to pay that difference from the money the seller set aside for you in this escrow account. They're going to say, okay, seller, so if we're going to do a 2-1 buy down, that's $250 a month difference on the first year cost because we're lowering it 2% for the first year of the loan. We're going to take all that extra money and we're going to put it and say, tally it up and say, okay, that's going to cost this much. And then they're going to lower the interest rate for the second year of the loan by 1%. So they lower it from 7 for the 30 years. First year is at 5%. 2% lower. Second year is at 1% lower, 6%. So 5% for the first year, 6% for the second year. And maybe at 6%, that makes a $110 difference in your monthly payment. So they're going to say, okay, so for 12 months, that's $110 for the first 12 months, then it's, $250. They're going to add all that up and say, okay, here's the cost of all of that. Seller, we can apply those credits that the seller's giving you to that. And so the seller is essentially prepaying part of your payment for the next couple of years, portions of your payment for the next couple of years. What it does for you is it takes a little bit of the pressure off. It makes the interest rate not hit your payment so high. It doesn't change what you qualify for because you still have to qualify at the full rate, the full 7% rate for that loan. However, it just takes some of the pressure off and it's the seller prepaying part of that for you. So if you're only going to be in the property for a few years or you're planning on refining in the next 2-3 years, a lot of times it's the most impactful way for that money to hit your budget. Okay? There's lots of different ways you can use seller credits, but with the temporary buy down, you get a lot of that money that they're giving you. It changes your monthly budget situation every month for the first couple of years. So it's a really high impact of a credit. If you apply it towards the price, it might only lower your monthly payment like $6 a month because you're amortizing that over 30 years. So yeah, if you sell in year 5 or 6, you have more equity. You have, maybe $6,000 more equity depending on what the market has done. But that may or may not matter as much down the road. And right now you just can't get into it because it's just so expensive every month. And you're like, man, if it was $200 cheaper, I could really feel more comfortable with this. So versus the long-term buy down where you're like, that's cool, but using that money to change my payment, I don't know, $50, $80 a month, cool, but I'm not going to be there long enough to realize all of that monthly savings, or I'm going to refi it and then that rate doesn't matter. All that money that I spent to buy down doesn't really matter as much because I'm going to refi to a lower rate anyway. So it's really just kind of figuring out the scenario that makes the best sense if you're in a market where you can negotiate some seller credits. That's a big if. So having a really good realtor makes a big difference on that. Reach out to me if you're in Denver. Reach out to me if you need an agent in another area. So I usually refer CRS agents. We're certified residential specialists. We're the top 2% of agents in the US. We have production minimums. We have educational minimums. It's pretty much the, hey, we know what we're doing club, right? So that's my network. Those are the people that I refer to because they take care of business like I take care of business, and I want people to be taken care of. But talk to your realtor and say, and your realtor is going to say, let me set you up or let me introduce you to these lenders. Because you can interview lenders too. You can interview agents, you can interview lenders. And trust me, all of my clients right now that are talking to a lender, they're like, well, I talked to this lender and they talked about a buy down or asking the seller for credit, but I don't quite understand. I'm like, cool. Here's a couple other lenders for you to talk to and see who can explain this to you, who's giving you advice that feels good for you and that makes sense for you. Because I have some lenders right now and they're not mine. They're just, I have a client doing a new build and the builder's lender, because they always give incentives to you, builder lender, is not explaining the scenarios in a way that my client can understand it. Honestly, I'm having a hard time understanding it because they're not giving all the information. So when you're talking lenders and trying to compare these options side by side, the term that you can use to ask is say, hey, give me a fee worksheet for each scenario. Give me they used to call it a good faith estimate for those that have been in the business a long time. But ask for like an itemized or a line item fee worksheet that explains each scenario as well as what your payment difference is each month with those scenarios, because it changes depending on if it's a new build versus, new build. It can change the price. On a resale item, it can change your closing costs significantly. It can change your mortgage insurance, varies a lot by lenders right now. There's a lot of change in mortgage insurance at the moment, and that affects the monthly payment quite a bit. So, but you really can't compare apples to apples unless you have all of those numbers for each scenario to understand, okay, this one's going to cost me more money up front, but I saved $200 a month. Well, if I can get the seller to pay some of that up front, then it saves me a lot more. Or, hey, I don't have the cash and I can't get the seller to do anything, but I can pay a little bit more each month. And that's where we can flex these numbers to make the best sense for your situation. So anyway, feel free to reach out to me if you have those questions. I'd be happy to connect you with people. All my info's down below. If you like this video or it helped you understand something maybe you didn't understand before, or you got a good takeaway from it, hit the like button. I would appreciate it so much. That'll help other people find it, because my goal is to help people understand their options so they can make educated decisions. As y'all know, I always preach that. So anyway, thanks so much. Subscribe to the channel if you like the content, and have a great day.